May I please request the gathering to kindly settle down? We will soon begin the second plenary session for the day. The second plenary session is titled Responsible Finance, Multiple Borrowing and Client Indebtedness. It is my pleasure to invite on stage the esteemed panel for this session. This session shall be moderated by Mr. N. Srinivasan, Sector Expert. And the panelists include Mr. Prakash Bakshi, former Chairman NABARD, Mr. Rajeev Ahuja, Head Strategy, Retail and Financial Inclusion, RBL Bank, Ms. Ratna Vishwanathan, Chief Executive Officer, Microfinance Institutions Network, Ms. Kalpana Pandey, Managing Director and CEO, CRIF-Highmark, Dr. Alok Misra, Professor, Public Policy and Governance, Management Development Institute. And we also have lead presenter, Ms. Parul Agarwal, Associate Director, IFMR lead, joining the panel.
You want to have some heart attacks in between? It will take 95 minutes.
I would now hand over the session to Mr. N. Srinivasan. In the interest of time, we'd like to cut short this session to 1 hour, 50 minutes. So we'll try to conclude this session by 1:20 p.m.
Thank you. I'm not going to introduce my panel. You might have had a chance to read through the bio of each of these persons here. And I'm not sure how many of them have actually borrowed, but they know enough about borrowing and enough to talk about excessive borrowing. If you look at the history of finance, not now, even from the Vedic times, it is never a problem with the borrower. Borrowing is not seen as a major sin or a major problem. But every religion has talked about lending as a problem. Actually, in the Vedas, probably it says, if my memory serves me right, it is one of the 7 gravest sins to lend money on interest. But then to borrow money excessively, with or without interest, I do not know where does it belong. Maybe the recent past says that it might actually be a virtue to borrow and even not repay. So this session is to try and unbundle what we call excessive debt or over-indebtedness. And maybe we get a few insights into what happens with the help of all of you. The session goes like this. Parul has a presentation coming out of a detailed study done by IFMR lead. And she will present some of the findings on how the debt levels impact households on the ground. And after she completes her presentation, we have the panel here who will be asked a series of questions. And I would request the audience also to start participating after they have been asked the first question. The second question onwards, it is free to you to ask. And if you do not ask questions, I will fill up the gap with my own questions that I have here. Right, Parul? You are on the air.
Organizers, if you could help me with setting this up. Okay, thank you. A very good afternoon to all of you. I am Parul, as Sir introduced me, and he has been kind enough to allow 15 minutes to me, and I have been incentivized to finish it in 14, so I'll try my best. I would begin by thanking Access Assist, SIDBI, and DFID to provide us the opportunity to conduct this study on the very important and concerning subject of over-indebtedness among microfinance borrowers. I just want to give here a word of caution that we studied this behavior among microfinance borrowers, but the study was irrespective of the institution. That means that we captured loans or borrowing from all the available institutions, including banks or informal lending like money lenders. So just to give you a context, I don't think it needs to be said here, as all of you are aware of it, but we have seen that MFIs have grown tremendously in last few years, and data suggests that they have also come out of the crisis of 2010. But new incidents of over-indebtedness have been surfacing in states like Orissa, Karnataka, and Uttar Pradesh, and the reasons are associated with pipeline loans, spending loan amounts on consumption rather than income generation, etc. So this issue, given that it has been brought up to light, is concerning to the sector, and we have tried to study what are the drivers to this over-indebtedness and what explains this behavior. So these are the various news clippings that we came across over the last few months as to about over-indebtedness, people quoting that these could be sporadic events or due to the infrastructural stretch for MFIs. So essentially, the sector divided itself into two schools of thought, one being that it's due to the infrastructural stretch because the growth in the portfolio is not really explained by, or it's not accompanied with concurrent growth in the number of MFI branches, employees, and clients. The other school of thought is states that this is more of a sporadic event, and these are not things to be concerned about. So Access Assist and IFMR joined hands to understand the relationship between microfinance, multiple borrowings, and indebtedness levels of its clients. And Highmark has been kind enough to share the data that they could to help us cross-relate things. So specifically, the study explores understanding the level and nature of over-indebtedness. So basically, what are the drivers of over-indebtedness, how they correlate with each other, and how it relates to the poverty levels and income levels of households. And it maps out any struggles faced by clients in the repayment of loans. Now, for this purpose, we identified Uttar Pradesh, Madhya Pradesh, and Karnataka as the three states where we conducted the study. And the districts and taluks were selected based on the broad data that was shared by Highmark. So how we defined over-indebtedness was using both subjective and objective measures, because it is a very tricky thing to define. In terms of objective measures, we use these two indices. One is monthly installments on business, basically the income, the debt, the amount that they use to serve debt by the total revenue from all sources, and then the value of this ratio was divided into 4, with people who spend around 40% or less than 40% of their income in servicing loans we have considered them not over-indebted. When this ratio comes in the range of 40 to 75%, we have considered them at risk. And the ones who are in the range of 75 to 1, they are in the critical phase. And people who are over 1, that is, they earn less than what they spend to service loans, they are considered insolvent. We have also considered self-reported parameter that there's a delay in repayment obligation of more than 3 times in a row is also considered as a factor that defines over-indebtedness. Apart from that, we did have subjective questions like if they feel stressed while repaying loans, or is there a stress in the subjective terms, that is self-reported stress, not based by facts and numbers. So just to go with the objective indicator, we see that 23% of our sample was over-indebted. And you can see how the numbers vary in these, the 3 districts. The similar numbers were observed also by a study that was conducted by IFMR Finance Foundation, where they see these rates as 21%. This was in Tamil Nadu, so we have an understanding of what's going on in 4 states. And the drivers of over-indebtedness, as identified by the research team, are low and unstable income flow, multiple borrowings, large borrowing size, poverty levels, use of loans, and cross-borrowing. Some of these are very intuitive and self-explanatory, but this is backed by data that we collected on the ground, and it has some implications that the sector should delve upon. So in terms of low and unstable income flow, we find that people who are engaged in seasonal occupations like agriculture or seasonal businesses are more prone to be over-indebted as compared to others who have regular cash flows. So that's one and very important finding. And just to mention, we also, like, these findings are complementary to the data that we collected during FGDs as well. In terms of number of loans taken, we find that the likelihood of being an OID customer increases as the number of loans increases, which is obvious. But we also see that as the number of loans becomes 2, the likelihood increases by 150%. So maybe there is a problem of defining defining the norms or regulation of what is the minimum number of loans a person should have. And when it reaches 3 loans, the likelihood increases by 576%. In terms of size of current loan portfolio, we find that as the loan portfolio increases by 1%, the likelihood of being OID increases by 1.18%, which again is intuitive, but it does indicate that maybe the amounts that are loaned out to customers are not matching well with their requirements or with the cash flows. Then in terms of poverty levels, we find that we used PPI indicator to estimate the poverty levels, and we find that the bottom 25% have similar loan portfolio as the rest of the households, which essentially means that people who have a difference of 20%, an income of less than 20% as compared to the rest of the households, they are also getting the debt flow as same as the rest of them. So for instance, the figure shows that they have a loan portfolio of 30,000 each, but they have incomes of 7,000 and 10,000 respectively. And they are equally likely to have more than one loan. In terms of use of loans, we find that the OID customers, that is over-indebted customers, they are highly likely to borrow for consumption purposes or non-productive purposes, and also the purpose for which the loan is used is also consumption in terms of OID customers. Now, this is something that the panel was debating earlier also, because it's very difficult to estimate or understand the usage of loan, as it just comes as a household cash inflow, and then the usage highly depends upon the situation and shocks that the household experiences. In terms of cross-borrowing, that is borrowing from an institution to repay an existing debt, we find that over-indebted clients are highly likely to cross-borrow as compared to not over-indebted customers, and the percentage stands at 21.5%, which is huge. In terms of implications, like what we can make out of all these findings is that multiple borrowing seems to be a common feature, a common phenomena. Credit bureau data helps us address this to a large extent, but there are signals that the loan sizes might be inadequate, and there is an inability on the side of the lenders to calculate the debt capacity. Now, this could be because of the insufficient data at hand, and also because the loan application forms that are currently used are not helping us understand the exact cash flows of a household. So this is something to be looked into. In terms of loan size, we find that again, like inadequate cash flow analysis, which results in varying loan sizes, which are not suitable for the household. So basically the insuitability factor of it. Also the cash at times, so during our FGDs we found that, and also Ratna was mentioning in our earlier discussion that people are borrowing because the loans that are given to them are inadequate in nature to service their current needs. In terms of poverty and loan use, the low and unstable income and people who are susceptible to who are more vulnerable to disruptions, they are not being catered adequately and they are highly likely to become over indebted. So maybe a product diversification in that sense is required to match the cash flows of the household. Also, again, like this is substantiated by the fact that different economic and occupational backgrounds use the loans differently, and it leads to, and their cash flows are different, which results in difference in repayment hurdles. So the way forward, I think I would request the esteemed panel to discuss what the way forward would be, but the key takeaway is that there needs to be a flexibility introduced. I'm not sure if that is operationally feasible or something that the lenders would like to look into. Also, the cash flow analysis needs to be strengthened, and that is something that I think is uncontested because the current credit bureau data doesn't give the exact estimates of cash flows or the income. They are not even near accurate. So, a look into that would be really helpful. Also, like the data needs to be more wholesome and comprehensive. I'm not sure, like it requires all the stakeholders to come together and play their role in that regard, be it regulation or the institutions themselves. Also, there needs to be some kind of financial education for clients to be put in place because, again, I would quote the study conducted by IFMR Finance Foundation that says that people should also be educated about the access to recourse, like what is, there is a personal bankruptcy code, they should be informed about that, and if maybe such rules and regulations once informed could help control this behavior. I will stop here and request panel to go ahead with the discussion. But we have authors Shambhavi, Srivastava, and Sakshi Mohan in the audience. So if you have any questions later on or clarifications, we would be happy to answer. Thank you.
Thank you, Parul. I think you earned your dinner today. You stuck to 13.5 minutes. Thank you. I think my first question goes to all the panelists. This is something that's a compulsory question in this examination. The question is, why are we even bothered with something called over-indebtedness when the sector says that more than 99.8 or so of their loan, that percentage of loans is getting recovered. Borrowers seem to be on good behavior, they keep on repaying. And lenders actually, based on this performance, expand maybe sometimes more than 100% from year to year. So what exactly is this over-indebtedness we are talking about and why we do? Yeah, Rajeev?
Thank you. So I think as a participant now, having spent about close to 5.5 years, both as a lender to the MFIs as well as doing business with BCs directly, I think it's important at every stage to assess where you are. I think there are challenges. I think, and I'm not saying actually the challenge is more from the borrower side, because the industry structure, the level of capitalization and the level of attention from an equity markets perspective does cause people to grow faster than their capabilities as well as the capabilities of the clients in the market. So I think it's a very important point to always do it, and as a lender, I think we assess it a lot more today. In the big scheme of things, which is the other view, I actually think that we've brought a lot of people over the last many years into a more formal system. So we should appreciate and respect that because none of this data ever captures the informal lending. The practices and the forms of personal challenges which people face going to the informal sector, whereas at least in the formal sector, we can have conversations around responsible lending. I don't think that happens in the informal sector with the same degree of investment of time. So this is a very important transition period. My other comment is that a rule which was kind of put in place in 2011-12, in order to simplify the practices of lending institutions, perhaps has not fully outlived, but in some manner needs to grow up. Because just a simple rule of number of lenders, size of indebtedness as a measure is not enough. And I think we've seen parallels in the credit card business, in the SME lending business in India and globally. So I think there will be a move to get more structured, put a lot more investment in the ground. I don't think we can be totally data reliant. So we at RBL are very positive about this sector in the long term. We believe this is a necessary cost which we all need to kind of absorb and build capacity around so that we can build a lot more responsible market than it has been. Yeah, thank you.
I think Rajeev has very well summed up the entire issue. We need to look at over-indebtedness or multiple lending from one very simple thing, perspective. 99% repayment is fine, but 99% repayment of how much amount? If somebody is repaying 10,000 rupees, will he or she be able to repay 15,000 and 25,000 and 50,000? I think we need to really learn from the crisis that we have passed through. I mean, if we have forgotten Andhra and Kolar and is still talking about multiple lending and over-indebtedness, that means for 3 years we have not done enough homework. Ultimately, as Parul has mentioned, the resources with the household and poor households are fungible. Whether the loan is taken in the name of business and used for non-business purposes or vice versa, the needs are there. And the one terminology which bankers use and Reserve Bank forces us to use, KYC, should not be reduced to availability of a Aadhaar card or a PAN card or a voter identification card. It is not availability of card, that is name and address fine. It is know your customer. How much do we know about that person? About that person's businesses, about that person's requirements, about that person's, in that household, the sickness, whether somebody is addict. All these affect, because why I am saying this is that in the morning also it was mentioned when Mr. Harsh Bhanwala was talking about infrastructure. When in Kerala, long back, 25 years back, I asked a poor woman, why are you poor? She said, I am poor because I don't even have drinking water. The solution was, what she was actually mentioning was that I spent 2-3 hours in fetching drinking water, which could have been used somewhere else. Why I am mentioning this is that, the over-indebtedness or multiple lending is coming because of many other reasons which we must understand at that point of time. And the context keeps on changing. The infrastructure keeps on changing. The advent of formal sector into households is changing. And unless we know how the business is really taking place, just because we are able to lend in a village does not mean that that person is going to expand that business. There may not be an opportunity to expand that business. A vegetable vendor will suddenly not start selling 3 times vegetables in the same village because of our loan, people have not started eating more vegetables there. Do that person have, that household have the skills to use those loans? I think it is here that we need to remember how SHG was created. It was not a mechanism for keeping record of transactions. Unfortunately, over a period of time, I have a feeling that we have come to that. SHG was a mechanism of appraisal. SHG was a mechanism of entrepreneurship development. SHG was a mechanism to see what can be done, what cannot be done. A typical discussion in SHG used to be like this. If I want to have a cow and somebody will ask, do you know how to milk a cow? Now, if that question is not asked, over-indebtedness will come automatically. We need to know what people can do, what people cannot do. And if they cannot do, then there is some entity which will have to see that they are able to do it. Otherwise, that loan is going to be infructuous. We also need to remember that over-indebtedness sometimes also takes place because of our deep concern that under-financing will also create a problem. Under-financing is as bad as over-financing. And I think we need to remember that. Thank you.
Okay. So one of the points that Parul did point out was about cross-borrowing. Now, one of the things I think today is that we don't have a lot of granular data on actual household incomes. So when we say that somebody is paying back and the sector is paying back at 99%, I think it's an indicator, it's a symptom of the fact that maybe we are not making an assessment of what really is the absorptive capacities of the families that are taking these loans, number one. Number two, I think there is also an artificial segmentation in terms of income because, and we have definitive income brackets. It's not even as if it's a range. If there is a range, at least there is a certain amount of understanding of flexibility in terms of how much money a household can absorb. Number three, access to the informal sector. Like Mr. Bakshi mentioned earlier, about 40% people still from low-income households borrow from the informal sector. And I think one elephant that we're all missing is today, post-Andhra and post-growth over the last 3 years, there's an enormous amount of money that's now floating in the market. So it's a case of oversupply as well. So when we take into account all of these factors, the need for growth from both the demand and the supply side, all of these factors lead to the over-indebtedness problem. And when we talk about bits and pieces, they are symptomatic. I think it needs to be looked at from a far more macro point of view in terms of actual definition. What is the need? What is the access that they actually need? What is the kind of technology that will really help? All of these factors, if we take it together, then we probably arrive at a much more realistic perception of over-indebtedness.
Hello. So basically from the credit bureau standpoint, if I put my views from that standpoint, a fundamental thing which I feel we need to ponder upon is what is the definition of over-indebtedness? I mean, is 20,000 we call as, I mean, it is over-indebtedness or 1 lakh, 3 lakh, what should be the definition? So if we ask a banker or an underwriter, generally the thumb rule that they follow is that the debt to income ratio should be around 40%. Now here in this sector, what we are talking about, the income estimation is a big challenge. I mean, one is that at times we look at the group income, or even that income also, that estimation is not rightly done. At times even the person who is getting, assessed, that person herself does not know what is the income. So these are some of the challenges that here the definition of over-indebtedness becomes a little flexible or challenging. But what I see that with this demonetization drive, now a lot of information would move into the digital mode. So now there is a way that looking at their behavior, that how they are paying, how they are spending, there is an analysis which can be done to assess that what kind of income band this person actually falls into. So in my view, with this demonetization drive, there is a huge potential that one can actually assess better income estimate and then do the assessment of the person. Now when we are looking at the assessment of the person to give loans, today, the way it is happening, and because of some of the rules which got formed in 2011 when we came out of the crisis, so that was the time when Highmark built the first microfinance credit bureau in India. So we started with like 30 institutions, and the database size that time was 21 million records. Today, after 5 years, we have more than 210 MFIs who are submitting data. The database size itself from the credit bureau standpoint is more than 320 million. Now, in this situation, we need to really look at whether the same guidelines should be followed or should we look at new guidelines. Now, that time, there were some norms which were set so that at least there is some control. So there were norms that not more than 2 MFIs lending and things like that. But now when we are looking at that MFIs are also giving individual loans. So this percentage which Mr. Srinivasan, we are talking about, that the NPA rates are really so low. But we are looking at only the MFI part of it. But if the same person has taken maybe individual loans from the MFIs itself, or maybe taken some loans from a bank, or maybe SHG loans, these are some of the elements, and even the informal sector. So then we are actually not looking at the overall picture. So there is a need to do a holistic review of the person. I think with that, I'll move.
No, that's fine. So I would like to answer the first question you was that why we are talking about over-indebtedness when recovery is 99%. The first thing is that we see that over-indebtedness is not all across India. It is only in some pockets where it is there. And for my field experience and whatever I see of the data, that why 99% still, despite being over-indebted or having more threshold of loan, are two-faced. One is the level of client relationship which you have. For example, I am a client. I have 3 loans, one from SHG, one from an NBFC MFI or an MFI, and one from a formal cooperative bank or whatever it is. The level of contact which the institution does with the borrower also leads to repayment rates. And despite over-indebtedness, the recovery rate in case of institutions which have much closer contact, for example, NBFC MFIs. When we talk about 99%, it is MFIs. It is higher. But when you look at the SHG bank linkage program, the overall NPA, it's not even portfolio at risk, it's gone up to 7%. In case of NRLM, if you look into it, similar methodology, around 30% of accounts are still in overdues. And same case in case of cooperative bank. So one is the level of contact which you maintain, where a borrower is incentivized to repay one institution over the other. And the second aspect of it is that when there is a pool of loans to take, when we are talking about 3-4 loans a client has, there is always an option for him or her to recycle the loans, keep paying back one, avail another loan, and keep paying back. That is keeping the cycle going together. And 99% is not one thing which you should take much comfort in it, because from 99 to 70 can be pretty fast. Thank you.
It's a wide range of issues that came out on this first question. I would like to get to you. You have, as you said, an own book from which you give small loans. You also have this JLG loans given through the BCs. I have been borrowing till yesterday from my MFI, and I got maybe 30,000 rupees. There was nothing wrong with that. When I wanted something like 1,20,000 rupees, they say you will be having an excessive debt. So I cross from your BC, I come over to your bank branch, and you give me 3 lakhs for buying 5 cows. I am supposed to be in a safely controlled debt environment. How do you explain this? What is that happens? That when I come from an MFI to a bank, this regulatory concept of excessive debt vanishes.
So I'll just clarify. We don't do anything other than BC lending. And we then lend to the institutions like the MFIs. But I think the lending practices are similar. So when we lend through our BCs, first of all, this is not a hands-off approach. We have people on the ground who are working with the BCs. We follow our credit processes. We ensure everything gets reported to the bureaus. We have a very strong risk management system. We look at heat maps, basis, our information, what we get from the industry, MFIN, etc., to assess what's happening on the ground. And we are also evolving our lending models and product models to take into account needs of clients which have grown beyond what I would call stretching the mutuality of obligations. You see, the JLG is a great concept as long as the indebtedness is of a reasonable size. The moment it starts becoming larger, I don't think the same social fabric holds. So we have to go to the individual borrower and assess most things around it. So which means household income, household expenses, other forms of debt. And I think this is a revolving journey. I don't think we get all the information today. So we try to be as close to the customer as possible. And even with BCs, we are very sure that it's our risk management and our technology which actually, combined with the local strengths, which actually makes this happen. As far as lending to the MFIs, we look at their practices too. So the idea is, we just don't want to lend blindly. So with some people, we lend a lot more. Some people, we don't lend at all.
I think you referred to heat maps, and I think also Alok referred to geographical issues. Kalpana, from your perspective, you have been analyzing the data. Would you say that there are some geographies where the tendency to borrow is much more than in others?
See, the way we look from the credit bureau data standpoint, so we see trends that how the lending is happening. Like we see almost now today the loan book, as of September, if we look at, it is around 93,000 crores of the gross loan book. Now in that, 58% of the lending that is happening in 5 districts. And if we look at the top 2 districts, they are contributing to 28%. So I think these are some of the insights. Similarly, if we look at how the average ticket size is moving, because we see that average ticket size is moving all across, but in some geographies it is increasing even more. Like if I have to just give one example, that in Kolkata, we see that the average ticket size has moved maximum, percentage increase-wise. However, in Kolkata, if you look at the cost of living should be not so much, if you compare with other cities. So these are some of the analysis that we see, and what I'm saying is one analysis is basis only the MFI data. But as we discussed, we need to actually look at the holistic view and see that how and where this is happening. Similarly, another picture can be painted through how the which MFIs are actually contributing to how much percentage. In a particular geography, there are a lot of MFIs who are lending. However, there are around 40 districts wherein there are no MFIs and there is no JLG lending which is happening. So there is a lot which can be analyzed from data, but I think then it needs to be assessed basis the specific geography-related situations and context, and then some analysis can be made.
Ratna, how much of a headache is this for you? The geographical flare-up, the hotspots, how do you actually look at it from MFIN?
Okay, so I think we also need to look at the whole aspect of MFI lending in a more holistic manner. Microfinance, that is NBFC MFIs, we account for actually about 24% of the entire pie. Right, sorry, 34% of the entire pie. 38% is SHGs, 22% is banks. And with the SFBs moving, obviously the bank percentage is going to go up. And also we need to understand that 50% overlap exists, as what Kalpana explained earlier, between SHG and MFI clients. So if you look,
because you have seen this at all the levels, right from homestead financing design in Kerala up to agricultural credit policy for small farmers. How do we form this question? When we talk about indebtedness, there is a regulatory standpoint which says not more than X number of loans, not more than X amount. There is a customer standpoint which says this is not affordable for me, I cannot service this loan anymore. Now, by prioritizing the regulatory standpoint, are we limiting people's choices? Are we leading towards providing what we call underfinancing traditionally, inadequate loans to meet what the borrower has to? So the borrower is left to her own devices as to match the shortfall, actually breeding more of unaffordable debt. So how do we actually look at this?
Yeah, I agree with you. In fact, very honestly, I do not agree with the present regulatory recommendation. We cannot limit anybody's number of borrowings that one can make from number of institutions that one can make. I think all the people sitting here, I can challenge, and I'm willing to take a bet. At least 60% will have more than 3 credit cards or debit cards. Now, if we can actually borrow from 3 or 4, and credit cards are all borrowings practically, and that is for consumption. Most of the credit card borrowing is actually consumption loan, and we happily give that. Now, if we can have, I don't see any reason why the poor cannot have, that on the philosophical issue. But at the end of it, as everybody has been saying, the loan will be repaid through the income that you earn. And we must have a good understanding of where the money or the resources of the household go. Whether it is formal institutions, non-formal institutions, their own income, there has to be and as Alok was saying, we don't have to really put a balance sheet there for where the money has come from and where it is going. I think a continuous dialogue with the household brings out more than a one-time assessment. It is something which is unfortunately being forgotten in rural lending by the bankers and by MFIs, by everybody. The more you know the people, and that is why I said KYC is not documentation. KYC is knowing the household, what happens there. We are talking about 99% recovery through multiple borrowings, as Alok also said. Why borrow from one and repay to another? Keep on that cash flow movement. But I am also talking about institutions where, like, I think the bankers who know cooperatives know that primary agricultural development banks are perhaps the worst banks so far as repayment performance is concerned. And there also you have examples with 99% recovery. And these are institutions, they are handful. You can count them perhaps on 2 fingers, if not 1 finger, who have maintained a very good touch with their borrowers. If a child is born, the secretary of the PLDB knows that a child is born there. If a death has taken place, the secretary knows that a death has taken place. And we stand with them in their good times and in bad times. I don't see any reason why anybody would default. I will give one very, very different example. During the cooperative reforms, I met a secretary of a primary cooperative in Haryana who was doing reasonably well. He was just 12th pass. And I saw in that village a lot of tractors going to another village for filling diesel. So I asked him, why don't you take a diesel outlet? And this secretary, 12th class pass person, he said, sir, your idea is fine, but instead of a diesel outlet, I would like to take a cooking gas agency. And I asked him, why? I mean, this has nothing to do with agriculture because you are a primary agricultural cooperative bank. He said, sir, because of the cooking gas, the wife of the farmer or the daughter of the farmer will come to me every month. And when I ensure that her kitchen is always having gas, I can also ensure that the tractor loan will be repaid. What he was trying to teach me, I mean, I had 30 years of banking, rural banking experience, but I learned a great lesson. You need to understand the household requirements. It is the house, the entire family which becomes loyal to you. Then you will not have defaults, there will not be over-indebtedness, there will not be excessive borrowing. I have examples where, right from poor Jharkhand, where I asked the SHG women that, okay, the chest is open, please take as much money as you like. And the women said, why should we take? What will we do with the money? Ultimately, we have to pay it back with interest. And there is no business opportunity. If the woman, the so-called poor woman can say that, I do not understand why the lender should not understand whether the poor woman can pay that back or not. Ultimately, it is a question of appraisal. We need to understand that we need to appraise on a continuous basis. Appraisal of a rural household, if you want to continue business with them, is not a one-time phenomenon. It's a continuous relationship. We need to find ways of how to reduce the cost, and SHG was a way of reducing that cost using the group mechanism to do the appraisal for us. There are other ways also. Now that so much data is available, maybe we can analyze that data and also merge it into something else. So our appraisal mechanisms will have to improve to reduce our costs, but appraisal cannot be given away.
I think, Ratna, there is some food for thought from what Prakash was saying. Do you think right now the way we do very small ticket loan to millions of customers using this facile group model, does it actually permit MFI's space, the time, and also in terms of cost, something that really understands the borrower and gives away loans? I think audience can start getting in from this question onwards. After Ratna answers, you are all free to raise your question. I hope someone is going around with mics. Yeah.
In an ideal world, of obviously going right down to your customer, to his household, understanding the household and understanding the needs of the household is something that is really important to small lending. Considering the small ticket sizes that MFIs lend, now one also has to, I think, have a realistic perception of the fact that, you know, the investment involved, because today we are taking household income as a self-certified income. And the ticket sizes are small. Now, I'm sure no person doing business, I mean, everybody does a fair risk assessment. And so from that perspective, the amount of money invested, in case you had to go household to do the kind of verification that is required to actually create the base layer for the engagement with your borrower at that point, I think you balance the two somewhere, because if it's not cost effective to the lending organization, somewhere it will fall apart. So there needs to be this really fine, delicate balance between how much you will invest for what ticket size to go to what depth of granularity of understanding of your client. And today this is, and actually after the credit bureaus have come in, I think that has also bolstered a certain amount of, you know, understanding that this is information that really helps us in understanding the creditworthiness of the borrower. Maybe not really the truth, but at least it's a level of confidence and a level of comfort. So I think you balance the two, and whereas it would be ideal if you went from house to actually verify whether the money taken is for the intent for which it is stated, whether it is being used for anything else, because at the end of the day it's a basket. When you look at household income, it's a basket. And when I say that I'm taking this for X, am I really going to keep a book saying I'm using it only for X? No, it will go into that common basket, and which portion of it goes into consumption and which portion of it goes into anything else, I will really never know.
Questions? Yeah, mic there, please.
My name is Amit Arora. I work for the World Bank Group, and I hope I'm not asking the wrong question. Just in case I missed this part of the discussion and my question has already been addressed, please skip. And the question is for Dr. Bakshi and Ratna. I just heard the overlap portfolio between MFI customer and the SHG portfolio. Given that the MFI basket credit reporting happens to the credit bureau, but the SHG side does not. We've been grappling with this question for some time now that there is a regulation. Sir, is this complexing the SHG business too much, expecting the member level credit reporting to be done to the bureau? Or this is something which we should take forward and move towards? Will this help in mitigating some of the aggregated risks? So request both of you to give some inputs on that.
See, let us remember that if NSSO data has to be accepted, almost 45% of the net debt outstanding is from informal sources, informal institutions, money lenders, friends, relatives, which doesn't come into the credit bureau at all. Now, unless we know that also, if a household has borrowed from a money lender, if a household has borrowed from an uncle or an aunt, which also has to be repaid. And please remember, NSSO also tells us, this data also tells us that more than 2/3, almost 70% of this non-institutional credit is at interest rates of more than 20%. So whenever the question of repayment comes, and don't think that money lenders don't want to get back their loans. I think they will try to get back their loans much faster than MFIs and banks. And they are higher interest loans. So the preference will be always to repay them and default to those who have perhaps given you loans at a lower rate of interest, because there the risk is, the cost is less. So we need to know the total household situation, and it is not necessary, that is where again, we need to segment, as Rajeev was saying, that for small loans, very small loans, perhaps SHG, slightly bigger loans, JLG. After some time, this will not work. But this method will always tell us how to understand people, how to understand what happens in that village. A loan in a village does not get repaid only because of an individual, but also what happens outside his own household. You must know, if you want to expand that business in the village, how do you reduce your cost? Not by having one loan here and another loan 25 kilometers away. You try to have more loans in the same geography. So you must understand the geography, you must understand the market, you must understand the businesses that take place there. To know what shirt Srinivasan is wearing today, I don't have to go to him. Perhaps I can ask Vipin what shirt Srinivasan was wearing. And there are ways of finding out, and in a village, it is very easy to find out. In fact, when we tried to do a poverty survey, we did not do a household survey. In LFP, we went to the headmaster of a school and asked, according to you, who are the 10 poorest people in this village? Please give me. Use your own criteria. I did not even give the criteria. He gave me 10 names. Then I went to some panchayat leader. I went to some shopkeeper and said, please give me your list of 10. Believe me, 7 names were common. Without any methodology being given to them, 7 names were common. How did they do it? Because everybody knows what is happening there. Everybody knows who is the poorest. Everybody knows who is a drunkard. Everybody knows who is sick. Everybody knows who is a farmer. Everybody knows who is cultivating which crop. So appraisal in rural areas, in urban areas, the situation will be a little different. But in rural areas, doing appraisal needs a definitely different methodology, and we must learn that methodology. It is not only creating a database, it is always keeping our minds open and walking a lot.
To answer your question, Amit, I think I'll step back a little because I think the size and the interest really don't matter. It's the flexibility of repayment that matters. So if I have 4 loans or 5 loans, and the person who's going to be more accommodative, I would probably pay their installment, the furthest. For instance, in the informal sector, people are happy to extend those loans for a longer period, A, higher rates of interest, and B, because they don't ask questions and the principal almost never gets repaid. So they are happier to extend that. Whereas loans that are structured, then obviously have a quicker rescheduling, a quicker schedule of payment. And you also understand, because I think one of the reasons for the 99% repayment is, and this is something Professor Yunus has also said, poor people actually look to pay back their money because they know that a lot of their sustenance actually dwells on that, and they would need it for their next cycle and the liquidity for the fragile businesses that they run. Now, as far as the SHG and the MFI data is concerned, there will be areas of overlap because I think the SHG structure came in much earlier and was one source of people without access to funds, having access to funds at that point in time. The MFI followed. The models are different. One is towards collective activity, the other is towards individual activity. I think the convergence point which really should be impacting decision making is the fact of the indebtedness factor, where both the loans need to be taken into cognizance along with other borrowings, including informal borrowings, and that is where the indebtedness factor would come in. So yes, in a sense it would help with both the SHG and the MFI data in place as far as the credit bureaus are concerned, but still, are we still getting the whole picture? I don't think so.
Hi, I'm Karuna from State Bank Institute of Rural Development, SBI. My question is, in the credit bureau data, the fact of the income of these clients, which is mostly unassured, how is it being factored?
Today, actually, credit bureaus come under RBI Regulation Act, which is called CRIF, Credit Information Companies Regulation Act. And as per that, only the credit-related data comes to a bureau. So there is no income level data which comes to a bureau. So from that standpoint, credit bureau cannot tell you that estimation. But if the entire borrowing of a person is coming to a bureau, then there could be some analysis which can be done, and basis that one can actually do an income estimation. I mean, as I was saying earlier, the debt to income ratio, if you say that if the proper underwriting happened at the time of every loan, which means you can actually derive that what would be the income of this person. But if we get access, and there are discussions with RBI also, that this payment bank data or like telecom data, utility data, if other data starts coming to a bureau, then bureau can give you some more perspective that how is the behavior, how is this person's behavior, some kind of trends that whether he has been paying, what are his other utility bill payments. So with that data, one can actually make some more estimations and do a better analysis while doing the loan.
Yeah. I would like to have a supplementary question on this.
Can we shift to someone else? You can come
Yeah.
later.
Sorry, I had my hand up earlier. I believe multiple borrowing takes place because MFIs don't lend enough. And MFIs don't lend enough because they lend through the group processes and they want to keep the loan size small. Ultimately, it's about lending a significant amount to individual clients so that all their needs can be met. Unfortunately, the credit bureau does not capture information from all lending sources, and therefore just relying on the credit bureau to ensure that you know to what extent a client is indebted is insufficient. What is needed, and this is something that has not been mentioned up to now, is if you have a large enough loan, 1 lakh or whatever, 1 lakh, 120, 150, then you can, then you have a higher margin which you can use to do proper appraisal of the client's needs. Now the problem is that most MFIs don't want to do this because their present staff base is not capable of doing that kind of appraisal. So I believe that the entire technology of underwriting for microfinance loans needs to be changed fundamentally. You need to hire different people to be loan officers. You need to train them appropriately. Training is something which is not being sufficiently emphasized. A very strong emphasis on the training of loan officers to do good loan appraisals along with higher loan sizes is what is needed. One final point. The environment in the microfinance sector today reminds me of an article that was written on stock market crashes. It was called, "It's Different This Time." MFIs are forgetting all the signals today are the same as those in 2009. And I'm a veteran of this sector. Let me remind you, all the signals are exactly the same. Beware.
I would like Alok to pick up this. So how do you respond to what Sanjay had to say? Then I'll get to Ratna on this.
Okay. I think the point is well taken that it's not economically efficient that if you lend to a same client who wants 70,000 from 3 institutions. The point about what he made, Sanjay made a point about training and appraisal skills of higher individual size loans. But there is also another side to it because I think the point relates to the income level of the clients which you are lending to. And if you are truthful to what the regulations say of 1 lakh or 1,60,000 income, I think the present size of MFI loans is a good enough thing. But if we for a moment think that that's just on the paper and their incomes are much higher, around 5 lakhs or 6 lakhs in place of 1.5 lakh, then I think individual loans is the way, and that is what we agree to it. But the current regulations don't allow that.
Ratna, the point that Sanjay also made was that there should be a fundamental reset of the technology of lending, the transaction process. How do you appraise? How do you lend?
Well, the appraisal process, I don't think I have too much of an argument. They need to be far more robust than they currently are, and there's argument, and I think industry's been looking at it. We've actually started identifying skill sets for loan officers. We're doing some kind of harmonization and trying to bring in training modules, all of that. Regarding, the kind of educational backgrounds, etc., since most of them are pulled from within local communities and you are providing local jobs, the skill building happens across various cycles because a lot of us have learned our jobs on the job, right? The second part of it is, I think the small size is also regulated, is a part of the fallout of regulation. So the MFI is not at liberty to lend despite the need, because like I mentioned earlier, we have now stratified an MFI customer within a certain annual income limit. And once you do that, there is no flexibility in terms of you making a realistic assessment of his real capacity to absorb that money. So maybe from a regulatory framework, you could look at it. And also secondly, once you cease being an MFI customer, nothing stops you from then becoming a non-MFI customer and going the next step up. So it's not really, if you look at it, an obstacle in any sort of...
I just want to add to what Alok and Ratna said. Because of historical reasons and the complexities which are involved in MFI lending, consumer lending and commercial lending, today in India, from a credit bureau standpoint, there are actually 3 logical partitions that there is an MFI bureau, consumer bureau and commercial bureau. So a person could be in a MFI bureau because the person has taken some JLG loan, but because of individual lending, that person could be reflecting on the consumer bureau also. But from a credit bureau standpoint, like today CRIF-Highmark, we have capability that we can in single report give you the overall borrowing of that person. So in a single report, you can check the overall thing, whether it is a JLG loan, SHG loan or the individual loan. So that capability exists today.
I think Sanjay has provoked almost everyone in the panel to respond. Rajeev also wants to.
No, so I 100% agree. We see the JLG as an entry point into the household. We don't want to, as I said, stretch the mutuality fabric too thin. It breaks down socially. We've already started investing in our BCs. So we don't, like I said, do a hands-off approach. Our BCs have to invest in training, technology, data. It's a journey. It does not become perfect. So I think there is a real need to pull most of these clients into the formal system. I mean, one of the interesting ironies is that at least here, we are challenged in talking about these things before something big happens, as Sanjay was alluding. And therefore, there's a need for us to come and develop market infrastructure through common platforms like MFIN. And it does not happen that, everybody can plow their own little furrow and then, you finally get something which is market standard. So I think there is a real need to recognize that there is a lot of good, but in that good, we've taken very simplistic assumptions post-2010 a bit too far. And we need to appreciate and course correct, because I think we are doing, at least in my view, a big deal to move people into the formal system. Costs of operations are coming down. So cost of information is coming down, and I think there is a real need to reinvest in that in the business to ensure that we have a longer, platform like this.
My question, if you haven't forgotten your question.
Sir,
please.
Hold
on.
Yeah.
There is a prior claimant to this question. Yeah.
Hi, my name is Swati, and sir already touched upon the question that I wanted to ask. It was about in microfinance, because scale is such a priority, because of which the products are very standard. So the first cycle loan would be 10,000, 15,000, then the second cycle and the third cycle loan. So customization becomes very difficult. So I want to know what is the panel's view on how we can balance quality with scale. And this is definitely where data and technology needs to come into picture. But then also, like sir pointed out, a relationship is very important. So as we bring in more technology, more data, and a loan officer who is already handling 800, 900 customers, how do we ensure that still that relationship is there? So I would like to understand the panel's view on that, and also just to my second question is that, do you see the business correspondent agents on the field, which are there in the village? Usually they belong to the same village and already have a relationship with the community. Do you think them playing some sort of role going forward as banks also, start to enter the microfinance sector through this model? Thank you.
Hi, I'm Shivgiri Swami from Empower IFMR project at Rajasthan. My question is before Ratna ma'am and Kalpana ma'am. So far as the rural indebtedness is concerned, the reasons for this may be from borrower oriented, may be from lender oriented, and may be from another reason which are not beyond, which are beyond the control of borrower as well as lender. There might be three categories. Is there any study or percentage or bifurcation within three sectors of reasons? If you are having, let me know.
Rajeev, if you could take the first two questions.
Sure. So I just reiterate what I mentioned in response to Sanjay, that I think most good institutions are already doing some level of training, customization, data, technology, in order to just expand the market and do the right thing. I don't think everything is happening as we speak, but it's a journey. And I think what is important for us to recognize that in this endeavor lies the health of this entire effort. If we go and simply just take a common size way of doing things, X number of lenders and Y indebtedness, that's not the answer. So if you take a geographical focus, a neighborhood focus, and I'll go back to Mr. Bakshi's comment, you need to have people in the market who know their clients. They can triage many information and use technology. So I think we are, at least in RBL, doing that. Your second question on BC, I don't think BCs today, at least the BCs we deal with, and you have one gentleman sitting on your right whom we had a long association with, I don't think we see them as different from us. If they are not equal to what we want or actually help us improve our standards, I don't think we want to do that business, because ultimately the customer is very critical here. So a BC is just not a simple DSA. In the urban world we have DSAs. This BC is an extension of the organization, in our case RBL Bank, in the local market. So with the BCs we do bank accounts. We're doing now the entire helping the customer base on the demonetization efforts, remittances, bill payment, etc. So the idea is to build a broader engagement as a bank, which we can. So our view is we're creating banking clients for the very future. The entry point may be a JLG loan, but it should just be regarded as an entry point.
Yeah, the other question?
Limited answer which I can give is from a lender. See, from a bureau standpoint, the way the data comes to a bureau, there could be some analysis which we can give. Like some of the things which we did in recent past is that how many people are having, say, borrowing with more than 3 lenders. Okay, so that kind of analysis, and then how are those loans performing? So if we see that a person has taken more than 3 loans, then he is more likely to default, and which is what was shown in Parul study also. So those kind of studies are available to some extent, and some deep dives can be done. So that much can be given from a credit bureau standpoint. But I didn't understand actually the later part of your question, that if the data is not available, then I don't think from... Yeah, maybe we could understand offline from him.
I'd just like to respond to the young lady. I didn't get her name. The one who asked us about, the touch point. And so the thing is, from within the MFI model, the USP of the MFI model is the feet on street model. So from inception, it's been a touch point model where your resources are from within local communities, understand the ethos of the local community, and then become the part of the MFI that helps evolve the financial activities within local communities. So as far as that is concerned, I think we're already there, we're playing that role. But yes, after, over the last 3 years now, we have multiple agencies coming into the same space. So there's a need for all of us to integrate the multiplicity that's coming in, and then I think educate borrowers a little more in terms of their access to credit, what it means to access credit from different entities, and that I think would be very helpful. And regarding the BC model, the BC plays a particular role. Like Rajeev says, different agencies use BCs differently. So although they are extensions of the bank, and I mean logically should all be playing to the same rules, the fact is it depends on who the BC is working for, and the ethos of that particular organization is reflected in the BC. And that is why today we have all these agencies trying to set up registries and rules and parameters. So that needs to be defined. But the role of the loan officer is pretty well defined, and I think it needs to be improved and taken forward in terms of integrating the larger reality today.
Yeah, just 2 points. One on the training of loan officers. So loan officers definitely need to be better trained, but it's also important to design the right appraisal instruments that MFIs can use. I think that bit is missing because the loan application forms are not sufficient enough to do a good cash flow analysis. So at IFMR Lead, we are trying to do that, like build instruments based on our earlier research studies that could be quick and more efficient as compared to the current instruments. In terms of customization, again, we are trying a customization in UP with Sonata Microfinance, where we are trying to see how the repayment schedule of small businesses can be aligned with their cash flows, business cash flows. And we are seeing a take-up rate of 30%. And it's an encouraging take-up rate from the customers. And so far, the repayment has been good as well. So we are yet to see how the entire product performs over 2 years. But I think customization, if offered, could lead to good business outcomes.
I think we are probably now coming towards winding up stage. I got at least one notice. Ratna, before we try to wind up, I had a question to ask. So far, we have been discussing the borrower could overreach, borrow more than what he or she could service for a variety of reasons. Sometimes they are ambitious, sometimes they are compelled. Then the regulator or the supplier determine what is a safe level to lend to a person. There is a risk-based definition of what can be excessive debt. It looks like in the last about 10 days, there is a new brand of people who come and say what is excessive debt which people did not repay. Are there issues post-demonetization?
Well, I have to be politically correct, but yes, there are a lot of issues post-demonetization. And one thing one has realized post-demonetization is that in a country like this, the unorganized non-farm sector has very little constituency because you do not have the weight behind you to pull for people where it matters to listen to you. And I can say this because I've been pushing it for the last, I think, 20, 25 days. And you realize that you reach a point and then somebody else gets precedence who has higher constituency. So I think it's a good, wake-up call for us to understand that we need to build and strengthen this sector a lot more in terms of the buy-in from whether it's the regulator, other external agencies, investors, anybody at all. And you need to pull together to be able to do that. By pulling in different directions, we are never going to achieve that. And that is primarily why we are here today. And so there is a need today for everybody who is a part of the sector, irrespective of entity. It should be entity agnostic, it should be sector focused to build that strength, that resilience and that constituency so that you have a voice when you go out there to be heard, because you do represent a very, very vulnerable population.
Okay, now the last question to all the panel members. Answer will be just one sentence long. What is that one step you think needs to be taken to ensure debts are within reasonable limits? Yeah, Parul?
I was hoping to get a response from the panel, but I think a better data assessment, as I just mentioned, is definitely required.
I had said it in the inaugural session and I will stick to it. That's eKYC.
eKYC.
So, so one sentence from me is holistic credit appraisal.
Appraisal.
Yeah.
Okay. Ratna?
Uniformity of lending processes by all players.
Okay.
I will repeat a better credit appraisal, and that can come only through a lot of sources, not just formal but informal.
So I have a little different view. I think if you grow the formal sector enough, the people in the formal sector are usually conditioned to doing things the right manner. We may make mistakes, we may do excessive, but the formal sector actually gets it right eventually, sometimes at its own cost. If you keep people away from the formal sector, you will probably not even know the extent of the problems.
I think that's a good harvest of what one steps. I hope somebody has recorded them. I think to sum up, we had a limited view of what is defined as over-indebtedness. We use some parameters about number of loans, circumstances of the person, the tendency to default, the stress and all that. But then there is a lot more about the level of debt that we don't understand, which the panel brought out. There are informal influences on how you borrow, how you repay, what you prioritize, and how much you have actually borrowed. And if 50% is roughly the level of debt that we do not know enough about because it is informal, and our discussions are limited to the remainder of the 50%, I think what Rajeev said, can we make much more formal? The second issue also is we oscillate between a supply side definition of what is excessive debt and also the demand side's aspirations to have reasonable sized loans to complete their activities or purposes, whether it's consumption, whether it is production, whether it is income generating activities. So are we in a position to harmonize how we understand this thing called excessive debt? And it need not necessarily be a risk-based approach where Sanjay was talking about, then you limit the loan size. Look, you might require X amount of money, but I think I can only take so much of risk on you. I would not take the balance, you go somewhere else. Then we divide the customer in 5 different parcels. He takes 2 MFI loans, 1 SHG loan, 2 informal loans, and then we all try and figure out how best we answer a politician's call not to pay any of the formal debts, whereas informal debt still gets paid, even within the context of what we call excessive debt. So harmonization of what we define as excessive debt, understanding that. And of course, there were, I think, 5 key principles or 5 priority points as to how we give debt that is not likely to prove excessive. All the 5 points are good appraisal, good appraisal, good appraisal, good appraisal, and so on. Nothing more than that. Do you understand actually your customer instead of collecting a card? That is what Dr. Bakshi was saying. So that's what we have, and thank you all for your patient hearing and the intelligent questions around. Thank you.
Thank you, panelists, for an insightful session. As token of appreciation, we request the panelists to accept souvenirs as they walk down from the stage. I now request Radhika Agashe to share an important initiative of ours.
Thank you for all your attention through the morning. We have had very good opening and plenary sessions.